you might say, okay, so you're telling me passive is better than active. I'm not. Actually, there's no such thing as a purely passive portfolio. Even index funds have rules and methodology that drive the results. So someone has to make those decisions. They just make them up front rather than every single day.
The world of investing is constantly in a state of flux. New themes like ESG and the dawn of digital assets create indices focused on delivering those themes, and that, in and of itself, has knock-on effects on financial markets. Mo Haghbin is Global COO of Investment Solutions at Invesco, and I discuss with him how indices play a role now and in the future, and what the future of investing might look like.
Well, Mo, thank you so much indeed for joining us for a chat this afternoon. Now, before we get cracking to talk about the world of investing, it'd be great if you could just introduce yourself and say a little bit about your background.
Sure, yeah. So I am the Chief Operating Officer for the Investment Solutions organization at Invesco. And what that means is we're really focused on creating portfolios for either institutional clients, so asset owners like pension funds, foundations, and endowments, or financial advisors, so the intermediated channel. And we cover both client types. And the key word is customization. We build unique, bespoke portfolios for those clients.
Okay, so can you talk a little bit about what those clients want from you?
Well, it depends, right? I mean, if you're a pension fund, there's lots of different things that you're worried about, like funded status. So if you're an underfunded pension, you're thinking about how do I get closer to funded to meet my future liabilities. If you're a financial advisor, what you care about ultimately is the financial future of the end investor, right? So thinking about risk tolerance and, what is the objective? Is it income? Is it growth? Is really what drives those conversations.
And then how does the asset allocation happen on your side of the
Sure.
business?
Yeah, so we're a multi-asset team. So we think about every asset class in the world, both public and private. And we're thinking about strategically, how do we want to be allocated to those various asset classes? So we think 5-10 year out horizon, but then also tactically. So you can make slight changes to your strategic weights in the short term to capitalize on opportunities. What's unique about our team is we implement through managers. So we're actually using ETFs and mutual funds, active and passive, to really create the optimal solution.
So let's talk about active and passive investing, because I think that's something that's changed a little bit in the world of investing over the last 5-10 years. So if we go back 5-10 years, what was the sort of environment like then for passive investing? And how has the world of multiple indexation offering so many more products change that?
Sure. So 5 years, I actually don't know if a lot has changed, but maybe 20 or 30 years, definitely there has been a change. And what I'd say is there was a problem that we were trying to solve for, which is the outcomes that clients were receiving weren't always the expectations that they had. And that was for various reasons, and it depends across asset class. But what's beautiful about indexing is it actually creates a way to transparently deliver something to a client, whether it's a pension fund or a foundation or a financial advisor, in a way that they can understand, that's rules-based, that's predictable, versus what we've had, I think, for a much longer period, which has been the active approach. Now, you might say, okay, so you're telling me passive is better than active. I'm not. Actually, there's no such thing as a purely passive portfolio. Even index funds have rules and methodology that drive the results. So someone has to make those decisions. They just make them up front rather than every single day. So the best outcome, depending on the client, is a combination of those things that delivers on what the objectives are.
I'm thinking back to my career when I was a portfolio manager, which is quite a while ago. And the more I'm guessing the more stable and sort of upward sloping the market, the more people just naturally gravitate towards passive investing, and kind of the more choppy it is, the more they want active managed. So would you agree with that? And is that sort of accelerated this move away from active and more to passive?
It's a really good question, and I think the data is mixed. And if you ask 5 different people, you might get 5 different answers. I do think that upward trending markets and what we've seen, let's say just post-COVID or really post-GFC, where the equity markets have been doing quite well, has maybe hidden some of the importance of diversification and some of the important factors to consider in a portfolio. So what we see, for example, in financial advisor portfolios is actually a pretty significant overweight to equities. Why? Well, because the way you own equities, generally speaking, is in a market cap framework. So as prices go up, you own more of something because price times shares outstanding is the weight of a stock. So over time, if you do nothing, your equity allocation will go up as prices go up. And it does kind of tilt the decision making more towards chasing return rather than building a diversified portfolio that can withstand, for example, a big drawdown. So for example, allocation funds. Allocation funds are really popular after a big drawdown. Right? Because people recognize, again, the importance of the ballast in a portfolio.
Yeah. So one of the topics I wanted to talk to you about is digital assets. Now, they are a small but fast-growing area of the market in terms of asset allocation. Is that something that you're trying to incorporate in for your clients?
Well, look, so because we're a multi-asset team and because we cut across both public and private, we have to look at it, right? Because it's an asset, and clients are asking about it quite a bit. But we also think about everything probably a bit more conservatively, and we have to be extremely sensitive to how something behaves within an overall portfolio. So with digital assets, as you know, the volatility is extremely high. So what is the optimal allocation? And I think having a bit more data and a little bit more time series will help us make better decisions around what's an appropriate allocation to that space.
Right.
Today, we don't necessarily think about that within the asset allocation process.
Okay.
What I will tell you is in the private allocation, we might invest in a venture capital fund that then takes positions in digital assets or the blockchain or the infrastructure behind digital assets, but we don't make a direct allocation today.
Okay, but demand, you do feel like demand is picking up for products in that area?
I mean, I do think so, because you have a bit of an evolution from something that has been mostly within the retail market.
Yes.
And focused on by individual investors. But more recently, financial products are being made available where you have institutional participation and you have financial advisors also having access to products that give them exposure. So for example, just recently, we saw a Bitcoin futures ETF list on the stock exchange. Well, that's a pretty significant development because what's happening is outside of that niche community that was investing in digital assets, now you have something that's listed on the exchange that's available to a much broader set of investors.
Which also gives it a kind of validation as well because it's had the regulation due diligence.
It does, yeah. And look, so we don't currently allocate, but just like any other emerging asset class, we have to care about it, right? And I think ultimately, if it's something our clients care about, we care about it.
Yeah. So let's talk about ESG investing, which has, been a big theme and a big trend over the last 10, 20 years. Does the increase the number of indices that sort of pertain to particularly that topic help you do your job?
Not really.
Oh.
Honestly, I think the topic of ESG, to me, is actually the perfect example of customized solutions.
Okay.
Because what you believe to be ESG may be completely different than somebody else I speak to in another country or another client.
This is interesting. So, it's like we still don't quite know how to define ESG in a way, or at least measure it.
Exactly. So it really is an emotional and personal decision sometimes. So creating a bunch of one-size-fits-all type solutions for something that is deeply personal it's challenging, right? So we find actually the conversation to be much more suitable for a consultation where then we design something from scratch rather than take something from the shelf.
I see. So if we can talk a little bit about the world of investing today, we're still in this very low interest rate environment. Is something you're thinking about and talking about is like, can the equity market keep going? What is a world going to look like where there's more inflation and interest rates rising? So can you give us some thoughts about how you see the world today?
So the macro backdrop, I think, is pretty suitable for risk assets still. I think to your point, rates are low. You still have the effects of a pretty significant amount of stimulus and easy monetary policy, and now we're seeing fiscal policy also supportive of risk assets. But I do think we are in a kind of critical period where we've seen a very significant portion of the recovery post-COVID realized.
Yeah.
Right. So asset prices have actually done, they've appreciated quite well. And there's not really, when you look across asset classes, anything that looks cheap necessarily. But I don't think that means we're due for a big correction or we're going to go into a contraction or recessionary environment. We have to recognize that even when the economy slows, it's still actually preferred to be in risk assets, right? So you're really trying to avoid big drawdowns and recessionary periods, and I don't see that on the horizon at all.
Right. I'm just thinking because right now, like if you're an investor and you've got some cash to put somewhere, it's very difficult to see where to put it. I mean, you and me were just discussing earlier, like New York real estate, it seems to be like impenetrable. It'll never go down. But sort of what are you sort of advising people in terms of where to put money? And maybe because the equity market's doing so well and interest rates are so low, naturally digital assets are getting more attention than perhaps they deserve because people are just trying to find anything with yield.
An inflation hedge or something with yield. Look, I think fixed income is a challenging asset class right now. So I think everyone kind of recognizes that yields are low and you're looking for a substitute in certain instances for fixed income. But I think you have to be careful because again, that portion of the portfolio historically has not really been the return generating portion, it's been the diversifying portion, right? So what I get worried about is people look at yields and they say, well, this is not giving me a standalone return that's attractive, and they forget about the interplay of asset classes within the portfolio, which is why fixed income has always been important. So we have seen clients move to alternatives, so maybe not all the way out to digital currencies, but private equity, private debt, infrastructure, real estate in certain parts of the market, for example, commercial real estate may look actually relatively attractive relative to residential. So that's important, and we do see allocations that have historically gone to fixed income going into alternatives, and policy benchmarks for institutional investors have increased the alternative weight. I mean, 20, 30 years ago, you might have gotten a 5% allocation to alts. Now you have 20, 30, 40% alternatives depending on the type of client you are and what your time horizon is. So if you have a perpetual time horizon, like a foundation, you are not worried about short-term liquidity. You're not worried about what happens in 1 year or 3 years or 5 years. You care about the going concern of that enterprise forever. So thinking about longer duration assets, like private assets, is actually a great place to find return over the long run. So back to your point, I think what I would say is, in a world where things aren't necessarily cheap, focus again on diversification, right? And focus again on a longer horizon outcome rather than thinking about, hey, can I avoid a big drawdown in the near term?
We're all getting very short-termist,
I think. Yes, we are, right? And I think we forget that over long periods of time, even the equity market has been incredibly consistent in terms of delivering a good result.
Amazing performer, Do you have a particular view on gold or a house view on gold?
Gold is interesting. I mean, clients all obviously ask about commodities quite a bit, and I think the commodity cycle is also starting to turn a bit where the performance on commodities has improved, right? We had a period where, if you looked at, the GSCI, it was actually not a very good performing asset class for quite a long time, but you've seen energy pick up in terms of price appreciation, and you've seen that physical assets like gold, again, become more important or more relevant to clients. Again, I think to your point around the highly accommodative policy that we have, we hear a lot about, well, look, we're printing all of this money. What's a good hedge for things like inflation, which if they're not transitory can have a pretty meaningful impact on performance and portfolios. The challenge with gold is it's not a positive carry asset. Like you don't earn a yield, right? So you're really thinking about just total return from a price appreciation standpoint. And gold doesn't also have like a natural utilization case that makes kind of the supply-demand dynamics interesting from a fundamental standpoint. So you have to kind of think about gold actually the same way you think maybe about digital assets, where you're not really looking for a yield, but you're looking for a total return and as a hedge or a diversification play in the portfolio.
Now, Mo, you've been talking a lot about trying to have a 5 to 10 year time horizon. I think that's a very smart way of thinking about things because we're always trying to think, how can we make money in the next 10 minutes? So as you look out 5 or 10 years, what are some of you think will be the real big issues over the next 5 years? Is it kind of a continuation of what we're talking about today, or do you think it could be some other things?
What can become challenging is, geopolitics and kind of the political environment are always going to be something that you have to pay attention to. And I do think, the world has moved a bit more towards a polarized state, right? Where, the things in the middle don't seem to be as talked about as the things all the way on the
We've
ends.
agreed on these bits. Let's vehemently disagree about these.
Let's really disagree on certain things. And, I do see that as a potential risk or challenge to markets when you think about just kind of the emergence of other economies around the world, their importance and relevance within portfolios, and then what does that do from a political standpoint, and what types of shocks could you expect in a portfolio from that? So, it's not just understanding the fundamentals of the asset. You also want to think about exogenous shocks or things that you aren't looking at that could impact the price of that portfolio.
And how about interest rates? I mean, do you believe that we're going to head into a higher interest rate environment, and how should people be thinking about it?
Not immediately, right? I think, and some people talk about policy mistakes and could you have one? I'm on the other side. I think we're going to not have a policy mistake. I think rates will stay subdued for some time in some sort of range-bound fashion. I don't think we're going to have this huge breakout at rates.
Right.
But over the we know we're bound to zero, I think. I mean, other parts of the world are not bound to zero. There's negative rates. But I think we're probably bound to zero here in the States. And, they have kind of one direction to go. So over the long run, yes, you should be thinking about it. But usually when rates go up, that's an indication that the economy is healthy and we're growing at above normal or above trend levels, and it's justified. What's dangerous, or I think what is potentially a risk, is if rates are going up while you're slowing in the economy. And remember, when rates go up, what is kind of the mechanism to price any asset?
Supply demand.
Future cash flows and the discount rate. So when the discount rate goes up, the value of future cash flows goes down.
Right.
And we know that there's sensitivity in that. Why? Technology, major sector within broad-based indices, rates are low, future cash flows or the expectation of future cash flows are high, so current valuations are high. But if rates go up, what does that do? Well, you're discounting those cash flows at a higher rate, price goes down. So, and if you're 30% or 40% of an index, that's going to have a meaningful impact on overall results when you turn on the TV and you look at the S&P or the Russell 1000 or the Russell 2000, right? So rates, I don't think are going to be a short-term issue, but as they go up, if they don't go up slowly, can have a meaningful impact on certain sectors that are sensitive to rates.
And how about the world of a question on consumer behavior? So the pandemic, I think, accelerated a lot of trends, and perhaps one of them was the rise of the retail investor. More people are at home wanting to be, in charge of their own savings and finances. Do you think that's something that is temporary, was accelerated by the pandemic, or are we now going to see more people taking control of their own finances?
I don't think it's temporary. I do think it was accelerated, right? So pandemic created an opportunity or an environment where people had the time to do some of those things. I don't think it's temporary, though. If you look at some of the structural changes in the market today, we have access to so much that we didn't have 20, 30 years ago, 5 years ago.
Right.
Think about commission-free trading.
Right.
That's a new topic. That's not something we were talking about before. So the friction for you to go into your account now and buy a stock or a basket of stocks is near zero.
And you can just do it on your phone.
And you can do it on your phone. So is that a good thing or a bad thing? Some people say, wow, you've got this huge kind of retail participation in the market and it's a new dynamic that we have to prepare for. I think it's wonderful.
Yeah.
I think it's great. You've democratized something that historically had very little connectivity back to regular, normal investors. So now if you have a $100 account or a $1,000 account or a $1 million account, you actually get pretty much the same service because technology has allowed something that historically was reserved for high net worth and institutional investors to come all the way down to anybody that has an account. Right?
Awesome.
So it's great. It's amazing.
Mo, I've had such fun chatting to you today. I just want to say thank you so much for your time.
Well, thank you for having me.
Thanks, Mo.
Trying to predict markets is nothing short of Sisyphean. It's as futile as trying to predict the future. But luckily, that's not the goal of an investor. The goal of investing is to make the best asset selection based on the available information and the risk-reward profile you are presented with, and do that consistently. We don't know what the future holds, but by keeping up with what the experts are saying about the future of investing. Well, that does give you edge. If you'd like to read more on the topic, please go to ftserussell.com/research for more information.